Sunday, June 28th, 09:52 a.m. New York time. Welcome back, investors, to Winning Wall Street's Money. We're almost at the end of the month. A few more days. The end of the month, as well as the end of the second quarter of the year. That means the last few days of this month, first few days of the new month, we'll have window dressing. Basically, that means financial institutions that manage other people's money and some people that manage their own portfolios, they do a rotation of their positions. They close out losers. They may add more to winners. They may take big withdrawals for cash reasons. They may want to pretty up their portfolio, look like they're in the leading stocks, leading sectors, leading commodities, leading currencies. Yeah, shenanigans to some extent, but certainly it's money management so they can stay in the business. Since we're also finishing the quarter, that means next month we're going to have earnings, public information of the financial books. And real basic, I'll share with you here the books. Media outlets, publications, not necessarily showing you all the content at the press release, but it's free public information at the sec.gov. Why I say that is because when people look at earnings, quarter to quarter or quarter compared to the prior year, same time frame quarter, is that organic growth? Or do they cut labor, cut management, take shortcuts on products or services? Or do they raise the prices, but not necessarily sell more product? Something to be really concerned about because, again, that's not sustainable. The best thing is, or one of the best things is to see more growth in the company, more sales, increased demand for the product or service, and also improving on those products and services. So first, let's go to look at the pending events coming this week. If you don't know, the United States has a federal holiday starting next month. It's called the Independence Day. Again, the name is Independence Day. It happens to fall on the 4th of July. That's not the name of the holiday. It's called Independence Day. We also have a holiday in November with a big bird, or some people might have lobster and corn. That go by the name of what? Hello? What name? Thanksgiving. Not the calendar day. We know what calendar day is, the third Thursday. Sorry, it's the Thursday. That also is the religious holiday called Christmas. We know what calendar day it falls on, but the holiday is called Christmas. So again, please educate other people that are putting misinformation out. This coming holiday is called Independence Day. 4th of July, that's just a calendar date, and other countries have 4th of July. Other countries have Independence Day. Seriously, own up and take better responsibility in communication. It's called Independence Day for a reason. That being said, I just told you it's on the calendar day of the 4th of July, which is a Saturday. But the United States financial institutions, the Wall Streets, banks, post offices, they're treating it as a bank holiday. So this is a short trading week. There are options that would be expiring the day earlier, Thursday, which is also going to be what? Like I mentioned, big trades would be going off, either accumulation, distribution, or both. People are misunderstanding when they see huge volume. Why I say that? Because people that work for companies that are contributing to investment funds, example, 401k, or maybe they're self-funding their IRA. A lot of people have money withdrawn from their payroll to go into their mutual funds the last few days of the month. So again, more money rolling into the stock market. That being said, you might have a short-term bullish bias. You might be bearish a market or a stock, trading short, And the stock goes higher because new money is coming into it for long-term investments. Good money management. Use caution. Yeah. So looking here are big economic news this week. As of right now, nothing scheduled Monday. And the red days are the biggest ones, Wednesday, Thursday. There could always be a surprise one, but these are scheduled, known binary events, okay? This month, we also have a Federal Reserve event called the FOMC. I know we just had one recently. There's several of them throughout the year. FOMC meeting, very important. As we get closer, you have 31 days, 4 hours, 1 minute, so no seconds. So the current situation is, again, this one would be Wednesday, July 29th at 2 p.m. when the Federal Reserve will release their information on how they voted. It's a board, it's a committee. Several members are on there. They all have a vote. Again, it'd be the second vote for the new Fed chairman. So the market right now, this is the current situation is target rate probabilities. Again, the current target rate, 350 to 375. So 70.1% anticipate it to be left unchanged. But what's going up now, again, this is going down. It's increasing, more likely. Market sentiment is the rates will be going higher later this year. May happen after elections. Rates go higher, it's because the inflation situation is getting worse. The Fed is very limited what they could do. The Fed is not the one that writes the check, signs the check. It's the Congress and the President of the United States that define, write the check, sign the check, how much they're going to spend. Again, the Federal Reserve has a mandate. Keep the dollar strong so we can control, again, giving a good option for the U.S. consumer, U.S. business. Of course, you want a strong dollar. To a certain extent, you want a strong dollar. We also want to have low unemployment. We also want to keep inflation low. The Federal Reserve is very limited what they can do, but most Congress members and media spread misinformation and basically make sounds like tear down the Federal Reserve. Again, Congress has the power to do a lot more, but again, they choose to do just enough to kick the can down the road. Yeah, the Federal Reserve does not set interest rates for credit cards, mortgages, auto loans, borrowing. Those are based on supply and demand from the individual financial institutions. That's a fact. The Fed just controls the overnight rate between the big financial institutions, the overnight rate. Big difference. So I say that because if you want to go to a bank and borrow money, let's just say $10,000 or $500, and you want to borrow it for 5 years, 10 years, let's say a mortgage. Say you want to borrow a mortgage for $100,000 for 30 years, and you're looking to get a rate at 5%. And the bank economic department, finance department, is understanding inflation is rapidly going higher. And they expect if they're going to give you a loan for 30 years and only charge you 5%, they would be losing money on long term. So they would crunch the numbers and figure out that maybe the better rate for their investment, because they're going to give you an IOU, maybe it'd be 7%. So again, I will show you how certain rates have been going higher, because what the anticipation is short-term and long-term in the futures market, the economy. And also comes supply and demand. You know, the financial institutions only have a limited amount of money to loan. So, of course, they might decide just to put it in a certain direction that's going to give the most return on investment. And some of them want to be in short-term investments. Not necessarily do they all want to be loaning money out for 30 years or neither 15 years. Yeah. So United States income we collect is from what? We collect it from taxes on income, federal level, I'm talking about. We also collect taxes and tariffs. We also collect taxes on other federal products that go down to the consumer. If you're not situation aware, the current administration, aka the legislation of Congress and the executive branch, both controlled by the same party, during their first year, was it the first year? Yeah, or first term, or first year, lowered taxes on the super rich. So that means the federal government collects less tax revenue, less money to spend, because remember, the super wealthy have larger incomes and they're contributing more as a whole in dollar amount to funding the federal government. But again, they also spend more money, so they have more money. Point is, Congress and the president made a choice, and they are again cutting back on the collecting income to fund the government. Adding the tariffs bring in additional money. And now we all have skin in the game because those companies that import products up front have to pay that tariff. And then that trickles down to the consumer. It's not enough income coming in from payroll or the tariffs. Why? We're on the federal website, again, showing you the increase. Yep. Compared to the federal spending of $4.85 trillion from the same period last year, October 24th to May 25th, the federal government has increased spending $56 billion. Yeah, 1% you might say is small, but $56 billion. So they've increased. Congress and the president colluded together, aka working together. Can you believe that? Working together? Yeah, the majority of the party is. So we're spending more money than we take in. That's not good. So we sell U.S. treasuries, IOUs, borrow money from people, pay interest on it. Just let you know, we are only paying the interest on the U.S. debt. Let's go to here. See what the current debt is. Current debt is over 39 trillion. We raised another 311 billion on top of that. It's terrible. Yeah. Wow. That's a huge increase. Not good. No, certainly not good. Again, we're only paying the interest on this. Not good. Fixed income products, U.S. Treasury. We're going to look at the current year, the current month, different durations. Let's go to the 1 year. So the first business day of this year, the U.S. Treasury Department had auctioned off if you want to buy a 1 year U.S. Treasury. Again, they have different dollar amounts you buy them in. But if you just wanted to buy the 1 year, aka the 12-month, you would have collected 3.83. Now go to the last trading day of last week. It's gone up 3.94. So if you bought one, it's past Friday, you could earn more. Let's go to the 2 year one. First trading day of this month, 405. And just last Friday, 407. So again, you got it. The United States is paying more interest just on the debt, the IOUs. Wow, not healthy. We'll go to the 10-year one here, far right, 4.47. Look at that. It went down. Interesting, right? So the 10-year, 20-year, 30-year, those are considered long-term. And these, like I was showing you, the 1 year, 2 year, all these are short-term. Big difference. I'll show you that soon. But basically, when Federal Reserve makes certain policies or certain statements, or the market anticipates certain things, the shorter-term ones react more. Again, higher yields, stronger U.S. dollar, higher interest rate, more debt for the shorter ones. Now let's look here on the 10-year one. Or did I show you that already? 4.47, 4.38. Yeah, in the 30-year, 4.4, 4.99, 4.87. Again, that's just for this month. On your own, you go look for the beginning of the year or higher since the beginning of the year. Basic. This column on the left, current, looking at the 30-year fixed mortgage, the average one, 6.53% for 30 years. So the high and low of the year, The low was 5.99. The high was 6.85. We were closer to the high of the year. Yep. So the 30-year is still higher mortgage based off the lows of the year. 15-year, the average, 6.12. FHA, 6.07. The veteran, 6.09. Just to show you some stuff here. We're not double digits, but we're above 5%. All of them above 5%, but we're not 10%. We're not double digits. It's not horrible. And you could adjust rates. You could buy points. You could spend money, get them lower. There's pros and cons. You could refinance. Again, this is not the U.S. Treasury Department. This is what the financial institutions are offering loans. Do your due diligence. There's so many financial institutions to choose from. Credit unions, traditional banks, partnerships. When I say partnerships, you might have a business with a bank, or you might have several accounts there with big deposits, and they might give you a better deal. Speak to the person in charge. Negotiate. Know what you want to do before you go. So the current credit card situation. Are you carrying debt? How many credit cards do you have? What is your credit limit? Has your credit cards recently reduced your credit limits? They often do that when the economy is getting worse. They want to reduce their risk. So the average credit card, last close of this week, almost 20%. That's terrible. Look, 19.57. It went back up from there. So we'll go all the way down to the, oops, I want to do the whole year. Oh, actually, so from February, right there, 1960, 1957. They all are in the 19 range. That's high for credit card. That's high. Not cool. Bank failures, traditional banks, the ones that are assured from FDIC. Not all banks are assured, but I'm talking about banks. So this year, right here, look here, the far right, 2026. So since the beginning of this year, we had 2 banks that failed. One in Illinois, one in Georgia. Now, these different banks have different money values and different number of branches. So when I say bank, that bank might have 20 branches. It might have 200 branches and their value in the holdings. So again, the government took them over and auctioned the banks off. Well, actually, yeah, they auctioned them off, and these are the ones that took them over. So with less competition, less banks. Not healthy, but again, the federal government, the FDIC, took action instead of letting things get worse. So the shareholders, the ones that own the banks, they're the losers. The customers were protected, thank goodness. But again, there's some people that want to eliminate this federal agency too. Yeah, that was going to be not cool for certain people. Yeah. So now we're looking at credit unions. Credit unions also have a regulatory agency. Look, all these from 2026. More, all these from 2026. Filled. Yep. Arkansas, California. So look back here again, filled banks. The banks, Illinois, Georgia. Got it? These were the 2 states the main ones were in. I say that because one's on the East Coast, Southeast, one's in the mid United States. So different. It's not just one part of the United States. I want to let you know. The situation is broad. Now looking here, since 2026, Arkansas, California, Pennsylvania, Arkansas, Mississippi, California. Yeah. East Coast, right? Pennsylvania, East Coast. West Coast, California, middle states. So got it? Where with the real estate bubble, when it hurt Florida, Georgia, Arizona, Nevada, California, certain states more than other ones. The bank's situations is widespread. That's the current situation with that. Let's continue. We're looking here at the U.S. Treasury yields. The first one is the 2-year. The higher the yield, the higher the interest rate. So this past week made a new high for the year. That's the short-term yield. This white vertical line was the prior FOMC meeting. Since then, again, the yields go higher, interest rates go higher. So the short term yield went higher. Now for the week, it made a higher high, higher low, but closed red back inside. But the trend is still up, higher yields on the short term, pushing US dollar higher. The middle one, the 10-year yield, it's red and closed lower, but also took out the high and low of that prior week. And the 30-year, lower low. So we have a divergence here. We have the short term making higher highs and the long-term lower lows. That's a divergence. Interesting. Let's go on to the next. Look at the bonds and the notes. Bonds and the notes trade inverse from the yields, which I showed you. There's different durations of these. The 1 year, 2 year, 10-year. Yep. So when they're 10 years or shorter, they're referred to as notes. When they're 10 years and higher, they're referred to as bonds. Looking here at the 2-year note, we mean a new low for the year. And I showed you the short-term yield, 2-year yield, made a new high for the year. So again, you understand the yields and notes go inverse from each other. Yields and bonds go inverse from each other. That's how normal things occur. Again, the short-term impacts the US dollar much more. A 10-year impacts mortgages, auto loans, company borrowing, US debt. So here we are at the 10-year, higher high, but also made a lower low, but a close higher high. And the 30-year, higher high, higher low. So we have a divergence here versus the short term and long term. We'll see how this plays out by the end of the month. Because again, I showed you next month, we're coming into another Federal Reserve meeting. Now the currencies, the US dollar. US dollar index, weekly chart, self-explanatory. Here's the low, 2022. Here's the high, 2022. Huge trading range, but we're still tightly trending up. This week, all-time new high for the year. US dollar's getting stronger. Again, I showed you the reason. Short-term yields also new high for the year. Impacts the dollar. You, if your income you earn paid in dollars, well, that's good for you because you have more buying power in other countries that get paid lower. Other countries that want to import and buy products and services to the United States, they have to spend more of their currency to buy US dollars to buy products and services. So they may have to cut back on expenses. They cut back on expenses, purchasing our product services. That company in the United States may cut back on labor, reduce hours, fire people, lay them off. Yep, residual effects. US dollar index, the 3 major currencies. In the row. Far left, the euro, new low for the year. That's the largest average currency in the US dollar index. Japanese yen, the middle one, second largest currency in US dollar, new low for the year. And the British pound, the new low for the year. So these are the 3 largest currencies in the US dollar index. Again, from the left, represents the largest average. So they're all doing the inverse from the US dollar. You want to take a vacation? You want to buy real estate? If you're allowed to, as US citizens still, again, some countries change the policies. Point is, there's a correlation. 3 major currencies in the US dollar index, new lows for the year. Makes common sense that the US dollar is higher. But again, I showed you regarding the yields and notes, what's causing that, and also the debt and the spending. Now we'll look at the US stock indexes, the major ones. S&P 500, closed red, lower low, lower high. NASDAQ 100 actually made a higher high and then closed below it. And the Dow Jones Industrial Average, the Dow 30, new high for the year. Again, the Dow 30, the middle one, the NASDAQ 100, and the far left, the S&P 500. Very different. S&P 500 closed red, NASDAQ closed red, the Dow closed green. The Dow made a new high for the year. The other two closed below the prior week. They're trending down. Now, on the far right, the Dow Jones Industrial Average. In the middle, the NASDAQ 100. They are part of this S&P 500. And to my Patreon members that are on the higher level, that are part of my WhatsApp group, and higher level, like I said, on Patreon, where they see the other videos, trade ideas, I shared with you during the market hours that I bought positions in the Dow Jones Industrial Average using derivatives, bullish positions. And I forgot to mention the US dollar also. Well, my Patreon members know that on my higher level. I also bought US dollar positions Friday too. So I have bullish positions on the US dollar and bullish positions in the Dow Jones Industrial Average, which come Monday, before the market opens, the Dow Jones Industrial Average, I gave detail past few days what's getting ready to happen in that Dow video. The company that manages the Dow, they're removing Verizon and they're replacing it with Google. Yep, Google is not part of the Dow Jones yet. Google is part of the NASDAQ 100 and part of the S&P 500. Yep, so they're taking off Verizon and adding Google. Again, they are different sectors too. Let's continue. Commodities, energy. Crude oil for the week, lower high, lower low. In a demand zone now. The gap has not got filled yet. Nope, little buyer stepping in. Me looking for a bullish trade if I get a bullish signal. And natural gas. Oops. It's in this massive consolidation. It's trending up. Yep, natural gas versus crude oil trending down. It's not interesting. Both energy. And again, they both have embedded costs to transport them, which some of them are stuck in the Persian Gulf. So again, the demand has not reduced. There's a big demand still. But in the United States, we have a thing called a strategic reserve of oil, aka crude oil. And we are using more of that faster than we're replacing it. That means our storage capacity is getting more empty and we don't have enough product to replace it yet. Again, that product runs to a critical level. What do you think happens? Well, if you remember the 1970s, when there were long lines at the gas station and there were restrictions for odd and even driver license plates and other things. Yep, other priorities. So again, we're not there yet, but it's a big concern. Going to the next commodity. Metals. Far left, gold, new low for the year. Silver, new low for the year. Platinum, palladium, how do you pronounce it? New low for the year. Copper made a lower, lower, lower high. And also posted that video a few days ago on lithium metal. Good insight. So now we're looking at the agricultural grains. Another category in commodities, corn. Corn is also used for ethanol. Corn is also used for animal feed. New low for the year. Suggest this here. Oops. Spilling counts, right? Rough rice. Wow. New high for the year. Huge. Impulse move up. Wow, something big happened on rice. Well, as I hear from some people in Southeast Asia, rice is life. In the Midwest, wheat, barley, oats, corn. But again, in some Southeast countries, I hear the phrase, rice is life. Certainly is. For that, there are people that they're staples. And wheat, inside candle for the week. Interesting. Wow, building a big consolidation up here too. Soybean oil. So we took out that swing high as expected, rejected it, trend down, reversed. And currently, soybean oil, lower low, lower high. Soybean meal, inside candle for the week. And soybean itself, inside candle. So we have several things here with inside candles. It means indecision, interesting timing near the end of the month too. Wow. Let's take it down here now to the livestock. Live cattle. Higher high, higher low, but close back inside. Feeder cattle. New high for the year, forming a bearish pin bar pair. Sorry, higher high, higher low for the week, but forming a bearish pin bar pair. And lean hog trending back down. That's the current situation. Wow. Thank you as always for spending just a little time with me. That's it for the video. Thank you for watching. Thank you for your support.